Let's talk about education credits. There are 2 education credits available based on qualified expenses a taxpayer pays for post-secondary education. Post-secondary just means college. Most of the time it means college. It can also mean something like a technical school, but we're talking about college expenses, not like private high school or private elementary school. Post-secondary education means college. The 2 credits are the American Opportunity Tax Credit, which is very commonly shortened to AOTC, and the Lifetime Learning Credit. Certain general rules apply to both of these credits, and there are also specific rules for each. To claim the credit for a dependent's educational expenses, the taxpayer must claim the dependent on their return. If you have a child that's in college, in order to claim either one of these credits, you have to also claim the child that's in college. This is not something where you can claim educational expenses related to a child that is in college if you're not actually claiming the child on your tax return. A taxpayer cannot claim education credits if he or she can be claimed as a dependent on someone else's tax return, files MFS, or has adjusted gross income above the phase-out limit. And the phase-outs are in your book. I don't think you need to memorize those for the test. I do think you need to memorize the credit amounts, though, and we're going to go over those. Form 8863, Education Credits, is used to figure and claim both education credits. Qualified education expenses are tuition and related expenses such as books and other course materials required as a condition of enrollment. Qualified education expenses must be reduced by the amount of any tax-free educational assistance received, such as Pell Grants, tax-free portions of scholarships, and employer-provided educational assistance. Basically, you can't double dip. If you are receiving tax-free educational assistance, like the GI Bill or a scholarship or a grant that you don't have to pay back, then you can't use those same tuition expenses if you're already getting that money tax-free. It's fine to have a tax-free scholarship or a tax-free grant. It's perfectly fine. But if the educational expenses are already paid for by tax-free money, then you can't use those same educational expenses in order to claim a credit. You have to reduce the amount of your qualifying expenses by the amount of tax-free scholarship or tax-free grants that you receive. Educational expenses that do not qualify include room and board, and this is even if the housing is on campus and a condition of enrollment. So there's some colleges that actually require, especially freshmen, like first-year students, to live on campus. There are some colleges that actually do require that, and then the students have to live in the dorms. Even if this is a requirement of the college or the educational institution, room and board, even if it's on-campus housing, is not a qualifying educational expense for the purposes of these credits. Any medical expenses, including student health fees, even if charged by the college. This is also a trick question on prior exams. A lot of colleges charge student health fees. You can go to the on-campus student health center and they'll charge you a couple $100 along with your tuition, and it'll be mandatory, those student health fees. But the IRS does not allow you to treat these as qualifying educational expenses, even if these are mandatory. Even if these are mandatory and the college makes them mandatory for you to pay them, because the IRS considers this health insurance. So it's not considered tuition or part of tuition or a qualifying expense, whatever you want to call it. It's not a qualifying educational expense. Remember that for the test. The student health fees are not includable as qualifying expenses. Room and board and student health fees are out. Any other insurance expenses, transportation costs, like if you buy a bus pass in order to get to the school, that's not a qualifying educational expense either. And any other personal, living, or family expenses. Those do not qualify. Requirements for the AOTC. The American Opportunity Tax Credit, also referred to as the AOTC, or sometimes you will see AOC. It's the same. The same credit, allows taxpayers to claim a maximum credit of up to $2,500 for each eligible student. The credit covers 100% of the first $2,000 and 25% of the second $2,000 of eligible expenses per student. So in order to get the full AOTC, you have to have at least $4,000 of qualifying educational expenses, because it's 100% of the first 2,000, and then it's 25% of the second 2,000. I don't know why Congress did it this way, but I think you do need to know this for the test. You have to know the credit amount is $2,500, and it's for each eligible student and how the credit is calculated. Because many times on the test, they will give you questions about educational credits, and you'll need to know which students qualify for the AOTC and which students qualify for the lifetime learning credit. It's not unusual for the IRS to give you a scenario where you have like a parent and they have like 3 kids in college and one of them's a graduate student and 2 of them aren't. And you have to figure out which one of the students actually qualifies for the AOTC and which ones qualify for the lifetime learning credit. Questions like that have been on prior exams. Qualified expenses include tuition and required fees, books, supplies, equipment, and other required course materials, but not room and board or student health fees. Unlike other education credits and deductions, the American Opportunity Tax Credit is partially refundable. The Lifetime Learning Credit is not. The Lifetime Learning Credit is a non-refundable credit. But with the American Opportunity Tax Credit, you can receive a refund even if you don't have a tax liability. Up to 40% of the credit is refundable, which means the taxpayer can receive up to $1,000 even if no taxes are owed. Requirements for the AOTC are as follows. There is a degree requirement with the AOTC. The student must be enrolled in a program that leads to a degree, certificate, or other recognized educational credential. Taking classes merely for fun or recreation does not qualify. It doesn't say they have to finish. They just have to be enrolled in a program that leads to a degree. They don't necessarily have to complete their degree, but they got to be trying. They got to be trying. Workload for at least one academic period of the year. One academic period of the year. Notice it doesn't say they have to attend all year. One academic period could basically just be one semester. The student must carry at least half of the normal full-time workload for his or her course of study. It also doesn't state that they have to be a full-time student. They have to carry at least half of the normal full-time workload in order to qualify for the AOTC. So they don't have to be full-time students. They have to be at least half-time students. One academic period of the year. No felony drug conviction. I always laugh when I get to this because this just shows you like the intelligence of Congress. They can't have a felony drug conviction. The student must not have a felony conviction for possessing or distributing a controlled substance. They will not qualify for the AOTC if they have a felony drug conviction. And you're supposed to ask your clients this. Do you have a felony drug conviction? The thing is that any other type of felony is perfectly fine. That's what kills me. Like, you could be convicted of murder, and you can still claim the AOTC. But felony drug conviction, you cannot claim the AOTC. I don't know why Congress just didn't make it every felony. I mean, if you're gonna go this far and put this into the law, why don't you just make it every felony then, where you can't claim the AOTC? But no, it's just felony drugs. But if you kill somebody, then that's fine. You can still claim the AOTC. That's Congress. But you have to remember this for the test. They've asked about this before. If a person has a felony drug conviction, they cannot claim the AOTC. They can claim the lifetime learning credit, but they cannot claim the American Opportunity Tax Credit if they have a felony conviction for drugs. Oh, and another thing that they've tested on before is a misdemeanor. A misdemeanor is okay. So if you have a misdemeanor drug conviction, then that's all right. But a felony drug conviction specifically, and just drugs, any other felony is perfectly okay. That's perfectly fine. But if you have a felony drug conviction specifically, you do not qualify for the AOTC. Okay? And then last but not least, it's only for the first 4 years of post-secondary education. And this is regardless of whether or not it takes the student more than 4 years to finish their bachelor's. It's only for undergraduate. Once you're taking master's degree courses and you've already finished your first bachelor's or you're working on your doctorate, then the AOTC is not available to you anymore. It's only for the first 4 years of post-secondary education, and it's only for a maximum of 4 years. If you have a student where they've taken 1, 2, 3, 4, 5, sometimes even 6 years to finish to get their bachelor's, it's only for the first 4 years. That also includes if it was a situation where they were being claimed by their parents. Like, let's say they were being claimed by their parents while they were a freshman and a sophomore in college, and then they moved out and they were on their own, and now they have a job and they're supporting themselves, right? They can claim the American Opportunity Tax Credit for 2 more years, but they cannot claim it for 4 more years. And the IRS actually does track this using the Social Security numbers that were reported on the tax return. So if you have a situation where the parents claimed the AOTC for 4 years for a student, and then they go off on their own and file their own tax return and try to claim it again for like a 5th year, the IRS will catch that and disallow it and send them a letter. Okay? The Lifetime Learning Credit. Now, the Lifetime Learning Credit is a non-refundable tax credit. There's no refundable component. If a taxpayer does not have any income tax liability, then they will not get this credit. It's 20% of qualified tuition, fees, and any amounts paid directly to the educational institution for required books, supplies, and equipment, up to $10,000 paid during the year. It's 20% maximum of the first $10,000 of qualifying expenses, and it's a maximum credit of $2,000 per tax return, not per student. The AOTC is different. The American Opportunity Tax Credit is per student. So if you had like 4 children in college, let's say you had like triplets or quadruplets, and they all went into college together, then potentially you could have a situation where you're claiming $2,500 for each one of those students. But the Lifetime Learning Credit is not like that. You can have 10 students on the tax return, and the most you're ever going to get per year is $2,000. And it's the first 20% of the first $10,000 of qualifying educational expenses, and that's it. So it's $2,000 per tax return, not per student. But this one is a lot more relaxed. A lot more people are going to qualify for the Lifetime Learning Credit, and there's no age limit or degree requirement. There's no, felony conviction restriction or anything like that. Basically, for any college courses that you take, you can claim the Lifetime Learning Credit. The requirements for the Lifetime Learning Credit are as follows. There's no workload requirement. A student is eligible no matter how few courses he or she takes. A student qualifies if the student is simply taking a course to acquire or improve job skills. There is no degree requirement. A student can be an undergraduate, graduate, or professional degree candidate. Professional degree candidate usually means doctorate. The courses can also just be for professional development. It's available for an unlimited number of years. There's no limit on the number of years for which the credit can be claimed for each student. And then felony drug convictions are permissible. A student can be convicted of a felony drug conviction and still qualify. Multiple students. It's not unusual for you to get a scenario on the EA exam with multiple students. You need to understand these concepts for the test. A taxpayer cannot claim both the American Opportunity Credit and the Lifetime Learning Credit for the same student in 1 year. However, if a taxpayer incurs educational expenses for multiple students, the taxpayer may be eligible to take the American Opportunity Credit for one student and the Lifetime Learning Credit for another student on the same tax return. In prior exams, they've given scenarios where the taxpayer themselves, like the parent, goes back to school. Like, let's say I go back to school and I want to get my doctorate degree. But then I also have students in college, like my kids are in college, and they would be eligible for the American Opportunity Tax Credit. And then I could potentially get the Lifetime Learning Credit in the same year. But you can't take both of these credits for the same student, even if you have more qualifying educational expenses that exceed the American Opportunity Tax Credit maximum. You just can't. So you could take both credits on the same tax return if you have multiple students. And let me give you an example. Armando is 49 and pays college expenses for himself and his dependent daughter, Sarah, age 18. So Sarah's in college and she's only 18, so she's an undergrad. And then he's 49 and he's going back to school. Armando is attending graduate school to earn his doctorate degree. Armando qualifies for the lifetime learning credit. Sarah is an undergraduate student in her first year of college. She qualifies for the American Opportunity Credit. Armando can take both credits on his tax return for each eligible student, which are Sarah and himself. The taxpayer can take the lifetime learning credit for himself. And even potentially, you can have a parent that can take the American Opportunity Tax Credit for themselves as well. Let's say I didn't have a bachelor's and I wanted to go back to college to earn my bachelor's, then I could do that. And I could take the American Opportunity Tax Credit for myself, and then also potentially even take the American Opportunity Tax Credit for my kids that are also in college. So there's no age restriction here with these credits. The restriction is that the American Opportunity Tax Credit has to be for the first 4 years of undergraduate work, which means bachelor's only. And then the lifetime learning credit is for graduate school. But sometimes you will have a person who's claiming the lifetime learning credit even if they don't have a bachelor's because they have a felony drug conviction and they're not going to qualify for the AOTC. Or it might be a person who's just taking courses for fun. Like maybe they're taking no credit courses because they want to learn something, but they don't have a degree in mind. Then that would also be qualifying educational expenses for the lifetime learning credit, but not for the American Opportunity Tax Credit. Because for the American Opportunity Tax Credit, there's a degree requirement. You have to be trying to earn your undergraduate degree. But the lifetime learning credit does not have a degree requirement, so you can't just be taking professional development courses or even college courses that you want to take. Example, Jim attends community college after spending 12 months in prison for a felony cocaine conviction. You already know how this example is going to go, right? If they tell you that the person has a felony conviction for drugs, you already know that they don't get the American Opportunity Tax Credit. This is probably going to be a question about the lifetime learning credit. He paid $4,400 for the course of study, which included tuition, equipment, and books required for the course. The school requires that students pay for books and equipment when registering for courses. The entire $4,400 is an eligible education expense under the lifetime learning credit. Although he meets all of the other requirements for the American Opportunity Credit, Jim does not qualify for the AOTC because he has a felony drug conviction. He may claim the lifetime learning credit instead. Poor Jim. I guess he shouldn't have been trafficking cocaine, but he can't take the AOTC. He can only take the lifetime learning credit. Example number 2. Betty works full-time as a paralegal at a lawyer's office. She takes a few night courses at a local junior college. Some of her courses are not for credit, but she is taking them to advance her career. Betty is not pursuing a degree. The educational expenses may qualify for the lifetime learning credit, but not for the American Opportunity Credit because the lifetime learning credit does not have a degree requirement. And that's the end. Next webinar is the Earned Income Tax Credit. Let's talk about the Earned Income Tax Credit. The Earned Income Tax Credit. The Earned Income Tax Credit is very commonly shortened to EITC or EIC. It's a fully refundable federal income tax credit for lower income people who work and have earned income and adjusted gross income under certain thresholds. This credit is claimed on Schedule EIC for the Earned Income Credit. Now, I want you to understand that the Schedule EIC doesn't have to be attached for every single claim, just most claims. If you look at the top of the Schedule EIC, there's a line up there that states that you only need to attach the Schedule EIC if you actually have a qualifying child. If a person is claiming the childless EIC, which we're going to go over later in this webinar, if they're claiming the childless EIC, then they don't need to attach this schedule. Although most of the tax returns that you're going to do where you're claiming EIC, you're claiming EIC because the taxpayer has a qualifying child. Most of the time. But there also is a childless EIC that taxpayers can claim when they're very, very low income if they meet certain tests. So I'm going to go over the childless EIC. as well as the regular EIC that applies most of the time when you have, a taxpayer that's claiming children. There are strict rules and income guidelines for the EITC. To claim the EITC, the taxpayer must meet all of the following tests. Have a social security number that is valid for employment. Have earned income from wages, combat pay, or self-employment, etc. Not be claimed as a dependent by another taxpayer, and be a U.S. citizen or a legal resident all year. Legal resident means a green card holder with a valid social security number. The social security number must be valid for employment, as I mentioned in the last slide. As you can see right here, if it says not valid for employment, that's not going to be a valid social security number for claiming the earned income tax credit. However, if it states, like on this bottom one, valid for work only with DHS authorization, that social security number is valid for employment. And the only way to make sure is to actually see the social security cards. If a social security card says not valid for employment, that doesn't mean that it's not a valid social security card. You can have a social security number that is not valid for employment. I have several family members that do. Many of them were like spouses or children of farm workers that were given the right to work in the United States and then returned to their home countries. But it's not like your social security number is revoked. You retain your social security number even if you don't retain your green card. And many times taxpayers will give up their green card and return to their home countries, but they don't lose their social security number. Once you get your social security number, it's basically your social security number for life. Your social security number remains valid even if you don't have a green card anymore. So you can have taxpayers that have a valid social security number that is not valid for employment. Okay, that's what it looks like at the top there. And then if it does say valid for work only with DHS authorization, that is a valid social security number that's valid for work. If you have someone who's a U.S. citizen, not a green card holder, then their social security number won't say anything. It'll just have their name and the social security number, and that's it. Qualifying income for the EITC. Only earned income such as wages, tips, combat pay, union strike benefits, and net earnings from self-employment qualifies for EITC. For EITC purposes, earned income does not include the following income: Social Security benefits, SSI or welfare payments, alimony even if it is taxable to the recipient. Taxable alimony is not qualifying income for EITC. It's not earned income. Child support also doesn't count. Any pensions or annuities, unemployment benefits, inmate wages, including work release programs, income from investments, passive rental activities, or other passive income sources. Income that is excluded from tax is generally not considered earned income for the EITC, but non-taxable combat pay and qualified Medicare waiver payments are a notable exception. They might ask you about the combat pay thing. If you have a taxpayer who's receiving combat pay because they're in a combat zone, they're a military service member in a combat zone, and their combat pay is not taxable. Their W-2 has a special code on it, and it's not taxable. But they can choose to treat it as taxable if they wish, if it will give them a better tax result. And many times, if you have a service member that's receiving combat pay, they will get a better tax result if they treat that combat pay as taxable, especially if they have kids, because they will be able to get the EITC and they will also be able to get the child tax credit. By treating that combat pay as taxable, they will get a better tax result and be able to get EITC. Just remember that non-taxable combat pay is a type of non-taxable income that's treated as earned income for this purpose. They're allowed to treat it as taxable for EITC and CTC purposes. And then you cannot exclude foreign income by filing Form 2555, foreign earned income, and get the EITC. So if you exclude foreign income, just having foreign income does not preclude you from claiming EITC. It's not the actual receipt of foreign income that's the problem. The problem is that if you exclude it. So if you have a taxpayer that files Form 2555, then they can't claim the EITC. Here are the EITC thresholds for the current year. You don't have to memorize these thresholds. The IRS is not going to ask you anything this detailed. But I do think you need to memorize the investment income limit.
This used to be really low. It used to be less than $3,000. The IRS has tested on this limit in prior exams, the investment income limit. If you have a person that has investment income that exceeds this threshold, this level of investment income, it doesn't matter if they have earned income. It doesn't matter if they're below these thresholds in this table. It doesn't matter. They cannot claim EITC if they have investment income that's above this limit. This limit used to not be adjusted for inflation, and now it is. So it's going to go up every single year. It's going to continue to go up to be adjusted for inflation. But if the taxpayer has more than this investment income, like dividends, capital gains, whatever, they can't claim EITC, even if their income is below the thresholds in these tables, for their filing status. Obviously, you're going to have a different threshold if the person is single, head of household, or qualifying widower versus married filing jointly. But if they have investment income that exceeds this, they can't claim EITC, regardless of what their income threshold is. And as you can see from the table, you can have a person who qualifies for EITC even if they have 0 children. It's just their income has to be really low. They have to have earned income, and then it has to be below these thresholds where it says 0 children. And the maximum amount of the credit that you can get for the childless EITC, that's what they call it, the childless EITC, is much less than if you actually do have a child, as you can see down here under the maximum credit amounts. It's a lot less. Congress raised the childless EITC, the credit, a couple of years back, but it went back down. So it's not very much if you have a person that's actually making less than this and qualifies for the childless EITC. I mean, it's free money, so you might as well take it, but it's a lot less than if you actually do have a child, the amount of the credit. Example, Jason is a U.S. citizen with a valid Social Security number. He claims his 18-year-old daughter, Cassandra, as his dependent. His daughter is a full-time student and a qualifying child for EITC. Jason also qualifies for head of household filing status. During the year, he received $39,100 in interest in dividends. So this is kind of a trick question, right? He has a valid Social Security number. He's got an 18-year-old daughter who's a full-time student, and she's a qualifying child for EITC. He's head of household. Everything seems fine, but he doesn't qualify because he received $39,100 in interest and dividends. Jason does not work, and he relies on his investments as his main source of income. He's living the life. He doesn't work. He just lives off of his investments. Jason would not qualify for the EITC because he does not have any earned income. Also, his investment income exceeds the maximum limit set for the EITC. So he wouldn't get it. He wouldn't get the EITC, even though his actual AGI is below the threshold for his filing status on that table. But he doesn't have any earned income, and then this is all investment income. So he's not going to qualify to take the EITC. Relationship test and age test. The child must be related to the taxpayer in one of the following ways: a son, a daughter, a stepchild, an adopted child, or a descendant of any of them. For example, a grandchild. A brother, a sister, a half-brother, a half-sister, a stepbrother, a stepsister, or a descendant of any of them. For example, a niece or a nephew. And then a foster child also qualifies for EIC purposes. The age test. To qualify for the EITC, the child must be age 18 or younger, so under the age of 19. A full-time student, age 23 or younger, or any age if permanently disabled. If the child is disabled, then there is no age limit. In addition, the qualifying child must be younger than the taxpayer claiming him or her unless the child, the dependent, is permanently disabled. Joint return test and residency test. The qualifying child, the dependent, cannot file a joint return with a spouse except to claim a refund. This would be very unusual. But you could potentially have a situation where a parent is claiming a married couple if the children, I'm going to say children, if they were married very young. So let's say you have two 18-year-olds or two 19-year-olds, they're married right out of high school. You could potentially have a situation where the parent is claiming a married couple. I've talked about this in other webinars. It's a very unusual scenario. It's possible. It's just, you're not going to see this very often, if at all, in your career. Because it would have to be, really young people for the most part, where you would have a qualifying child and they're married and someone is claiming them even though they're married. The only time you would see something like this is if you had like 18-year-olds or 19-year-olds that were married right out of high school, they're a really young couple, and then the parents are supporting them completely, then it's possible to claim a married couple. But in that case, if that married couple, those like teenagers, for example, file a joint return because they have some little piddly job or something, they can only do it to claim a refund. If you have a situation where you have two 18-year-olds and they file a joint tax return together and they don't check that box that says someone can claim you as a dependent, then the parents are not going to be able to claim them. You know, they cannot file a tax return except to claim a refund. And then even if you have a situation where they are filing a joint return, if someone is going to be claiming them as a dependent, they have to check a box on their tax return that says, can someone claim you as a dependent? I mean, I've seen this maybe twice in 20 years in my whole career. Residency test. The child must have lived with the taxpayer in the United States for more than half the year, although there are exceptions to this test for temporary absences. For example, if the child is away at college or hospitalized or whatever, those are all qualifying temporary absences. And when you put that information in your software, for example, if the software is asking you how many months, my software does this, it asks how many months the child lived with the parent. If the child is away at school, like at college, that is treated as time living with the parent. It's a qualified temporary absence. So you would just put it as if the child was living with the parent during the times that they were away at school or if they were hospitalized or whatever. Only a custodial parent can claim the EITC, or in the case of another family member that claims the child must have lived with that family member for more than half the year. A child who was born or died during the year would meet the residency test for the entire year if the child lived with the taxpayer the time the child was alive. If you have a baby that was born, for example, right at the end of the year, let's say you have a baby that was born in December. Obviously, they're not living with the parents for 6 months because the baby hasn't been on the planet for 6 months. They were just born. So in the case of a newborn or something like that, then they don't have to live with the parent for 6 months. It's still a qualifying child if they were living with the taxpayer as for all the time that the child was alive on this planet. You know, if you have a baby right in December, of course they're not going to live with you 6 months because they haven't been around for 6 months. They just came out. So in that case, that's still a qualifying child for EITC as long as they're born before December 31st. Example, Caleb, age 45, supports and cares for his older brother, Brian, age 56. Both brothers live in the same home. Brian is mentally challenged and permanently disabled. Caleb financially supports his disabled brother and also pays for his adult daycare program. In this case, Brian meets the criteria to be Caleb's qualifying child for the purposes of EITC, even though Brian is older than the taxpayer claiming him. And this is the exception to the general rule, where basically if you're claiming a dependent, that dependent has to be younger than you. If it's a disabled dependent, then the dependent doesn't have to be younger than you. The time when you're going to see this the most often is when you have a disabled sibling, and you have a younger sibling taking care of that disabled sibling after the parents have passed away. In this case, Brian, who is the disabled sibling, would be a qualifying child, not a qualifying relative. A qualifying child. So Brian would be a qualifying child for EITC purposes, and Brian would also be a qualifying child, not a qualifying relative, a qualifying child for head of household purposes, because he is a sibling who is permanently disabled. Got it? The childless EITC. A taxpayer with a qualifying child can claim EITC without any age limitations. But a taxpayer without a child can only claim the EITC if all of the following tests are met. The taxpayer must be between the age of 25 and 65. On a joint return, only one spouse must meet the age requirement. The taxpayer must not qualify as a dependent of another person. The taxpayer must live in the United States for more than half the year in order to qualify for the childless EITC. And let me give you an example. Danny is age 27, unmarried, and living at home with his parents. He does not have any children. Danny worked at a restaurant as a dishwasher all year. He is not disabled. Danny earned $13,800 in wages and had no other income for the year. Danny provided more than one half of his own support, and his parents can't claim Danny as a dependent. Danny can claim the childless EITC because he meets the age test and his income is below the income limits for the credit. He actually technically wouldn't have to file a tax return because his earned income is below the standard deduction amount for his filing status, which would be single, just barely under. But he wouldn't have to file a tax return, but he should. He should file a tax return because he's going to qualify for the earned income tax credit, the childless EITC, because he meets all of the requirements. His earned income is under the threshold and he's over 25. So he will get that extra couple $100, which is nice, right? Plus any withholding that he might have had from his job. Okay, that's it for this webinar. Next webinar covers other credits.
Let's talk about other individual tax credits. Let's talk about the Retirement Savings Contributions Credit. The IRS also very commonly uses the name Savers Credit. This is the same credit, and you'll see it both ways on the IRS website and in the IRS publications. I don't know why the IRS doesn't just decide on a name for this, but it's either the Retirement Savings Contributions Credit or the Savers Credit. It'll go by both of those names. The credit is 10% up to 50% of eligible contributions to IRAs and other qualifying retirement plans, up to a maximum credit of $1,000, $2,000 if the taxpayers are married filing joint, depending on a taxpayer's adjusted gross income. Eligible contributions must be made to an IRA or an employer-sponsored retirement plan, like a 401k. To be eligible for this credit, the taxpayer must fulfill all of the following requirements. The taxpayer must be at least 18 or older. Now, a person could potentially have a contribution to a retirement plan if they're under the age of 18, if they're working. There are parents that start, retirement accounts for their children, but you can't actually take this credit unless you're at least age 18. And that's true whether or not you're a dependent. I know that most 18-year-olds are claimed as dependents, but you have to be at least 18 or older in order to claim this credit. And that's regardless of if you're a dependent or not. The second one is that you cannot be a full-time student, and that's also whether you're a dependent or not. Potentially, you can have someone who's 30 and making retirement plan contributions, and they're a full-time student, but they're not being claimed by anybody. They still can't claim this credit if they're a full-time student. And I don't know why Congress did this either. Why would they make it so that you can't claim this credit even if you're a full-time student, but if nobody's claiming you? Like, you can be 30 or 45 and be a full-time student. I just don't know why this is in the law, why you can't be a full-time student and claim this credit. But this is true regardless of whether or not you're claimed as a dependent. In the form instructions, it says you can't be a full-time student, regardless of your age, and still claim this credit. So that I think is weird. I mean, it doesn't say anything about not claiming an educational credit along with this one. It's just you can't be a full-time student and claim this credit in the same year. And that's whether anybody claims you or not. And then lastly, you cannot be claimed as a dependent on another person's tax return. And this is typical, right? Most of the time, if you have a dependent, they're not going to be able to claim any credits because they're dependents. But these other two rules apply whether the person is claimed as a dependent or not. Most workers who contribute to traditional IRAs already deduct all or part of their contributions. The Savers Credit is in addition to these deductions. In essence, a taxpayer could potentially deduct their contribution to a traditional IRA or other retirement account and then also receive the Savers Credit in the same year. I want you to understand how odd this is. You can double dip with this credit, which is weird. You can take a deduction for your IRA contribution and also take this credit for the same amount. So that's really unusual. Congress doesn't usually let taxpayers double dip, but you're allowed to take a deduction for your contribution to your retirement account. I mean, assuming it's like a traditional IRA and not a Roth, because with a Roth, you don't get to take a deduction for Roth contributions. But you're allowed to make that contribution, take a deduction for it, and then also take this credit at the same time for the same amounts. So in this regard, this credit is really unusual. The credit is claimed on Form 8880, Credit for Qualified Retirement Savings Contributions. Here's the credit phase outs. You're not going to need to know the phase outs for the exam, but I think you do need to know the maximum credit rate. The most that you can take as a credit is 50% of your contribution, not 100%. If you contributed $1,000 to a traditional IRA, the most that you would be able to take as a credit would be half of that, 50% of what you actually contributed to your IRA. Like if I did contribute $1,000 to a traditional IRA, then my credit would be a maximum of $500, depending on my AGI. And the other odd rule with this credit is that single, married filing separately, and qualifying widower have a lower threshold than head of household. The single and the married filing separately, I understand. But why would qualifying widower be over here in all other filers? I feel like Congress screwed this up. Yeah, I mean, with qualifying widower, you have to have a qualifying child, right? That's one of the rules for qualifying widower. So why would head of household have a higher AGI limit than qualifying widower? Like I said, I think that Congress made a mistake here. Qualifying widower should not be over here in this bucket with all other filers, with single and married filing separate. Qualifying widower should have a higher AGI threshold than head of household. It should be over here on this column. But I feel like Congress made a mistake. So if you're qualifying widower, you get the same AGI threshold as single and married filing separately. The student thing I don't understand, and then this I also don't understand. Maybe Congress was in a hurry when they drafted this law, but that's how it is. Qualifying widower has the same AGI threshold as single and MFS. And let me give you an example. Paisley works at a restaurant. She is married and earned $41,000. Paisley's husband, David, is disabled and did not have any earnings. Paisley contributed $2,000 to her IRA for the year. After deducting her traditional IRA contribution, the adjusted gross income shown on her joint return is $39,000. I want you to understand the scenario here. She's the only one working, but they're married filing joint. So they're going to get a higher AGI threshold for this credit because they are married filing joint. Her husband didn't have any earnings. He didn't work because he was disabled, but she has wages. So she's able to make that contribution to her traditional IRA. She made a $2,000 contribution, and that's going to lower her AGI. Contributions to a traditional IRA are an AGI adjustment on Schedule 1. She's able to deduct that contribution. And then after she deducts her contribution, her AGI, well, their AGI on their joint return, because they're filing joint, is going to be $39,000. So she is able to claim a maximum 50% savers credit of $1,000. She gets 50% of her contribution on her tax return as the savers credit. She contributed $2,000, and then she gets to take half of that. That's the maximum credit rate based on her AGI and her filing status, because she's married filing joint, even though her husband didn't work and doesn't have any earnings. Credit for excess Social Security and RRTA tax withheld. RRTA tax is railroad retirement tax. This is specifically for people who work for the railroads in the United States. It's basically the same tax. It functions the same. This credit is for workers who overpay their tax for Social Security, which usually happens when an employee is working 2 jobs and both employers withhold Social Security tax. Each year, a limit is set on how much Social Security tax an individual should have withheld from their earnings. This usually happens when an employee is working for 2 different employers and they're making a lot of money with both of those employers, because the employer is required to withhold Social Security tax from all of the employee's earnings up until the annual maximum. And if, I'm working for one job, from January to June, and I make $100,000 in wages, and then I quit that job and start working for another job, like in the middle of the year, then that new employer is going to withhold Social Security tax from the full amount. They're required to by law. And then what ends up happening is I become over withheld for Social Security. I can request that over withholding, that excess, when I file my tax return, when I file my Form 1040 for the year. If the taxpayer's withholding for Social Security tax exceeds the annual maximum, the taxpayer can request a refund of the excess amount. This also applies to overpaid railroad retirement taxes. The maximum earnings subject to Social Security tax is $160,200 in 2023. That's the most that you would ever have to pay Social Security tax on. And that's true whether it's a mixture of self-employment earnings and wages, like maybe you have a person who has a Schedule C business and they're working. and both of their activities are making quite a bit of money, and they go over this $160,200 limit, they're only going to have to pay Social Security tax on this amount, on the $160,200. And if they get over withheld, then they can request a refund for the excess. And your software is going to just calculate this automatically. There's not some special form that gets generated. I want you to realize that this is one of the big mistakes that new preparers make. When they have a married couple and both spouses are working, and then both of the spouses are making kind of good money, they will mark both of the W-2s as being for the same spouse. And then the software will think that the taxpayer was over withheld, when in fact that's not the case. This Social Security cap right here, this maximum earnings cap, applies per person, per human. So if I'm working and my husband is working and we make less than this, then we're going to pay Social Security tax. The only time where you're going to get a refund for the excess of Social Security is if you have one person that makes more than this. If it's a married couple, you have to be really careful when you're putting their W. I'm working and my husband is working and we make less than this, then we're going to pay Social Security tax on all of our earnings. The only time where you're going to get a refund for the excess of Social Security is if you have one person that makes more than this. If it's a married couple, you have to be really careful when you're putting their W-2s into your software that you mark that W-2 as belonging to the person who it actually belongs to. And it's a very common mistake with newer preparers that they don't pay attention to that, or they don't think that it's important. And you'll have a situation where, okay, well, the husband makes $100,000, the wife makes $100,000. If you mark both of those W-2s as belonging to the husband or to the wife, whoever's listed as the primary, that's usually how they make the mistake. They'll mark those W-2s as being all for the same person. And then the software thinks that they've had excess Social Security tax withheld when that's actually not the case. And then the taxpayers will get a refund. And then later on in the year, like around June or August, when the IRS finally processes all the third-party information statements, including the W-2s, then the IRS will catch the mistake and send the taxpayer a notice that says, oh, you received a refund that you are not entitled to. This is a common mistake with newer preparers. You got to watch for that. This maximum earnings cap, this threshold, applies per human, per person. So on a married couple, on a married filing joint return, the Social Security tax cap is going to apply to each spouse individually. And then I also had another EA exam candidate ask, what happens with the excess that the employer pays? Like, for example, if you have an employer, they're paying half of the Social Security tax. The employee pays half and the employer pays the other half. What happens to the excess that the employer paid? Do they get it back? And the answer is no. It goes into the Social Security tax fund and the government keeps it. So if there is excess Social Security tax that's withheld, the excess goes back to the taxpayer. They get their half back, but the employer doesn't get their half back. That's not how it works. And let me give you an example. Zachary is a medical doctor. During the year, he works for 2 different hospitals as an employee. His first employer pays him $120,000 in wages during the year. The second hospital pays him $50,000. His total wages were $170,000, and the entire amount was subject to Social Security tax because each of his employers is required by law to withhold Social Security tax from the entire amount. Individually, between these 2 employers, he didn't reach the cap. Between these 2 employers, individually, like he was under $160,000 with the first employer and also under $160,000 with the second employer. So those employers are required by law to withhold Social Security tax from all of those wages. So he was over withheld for the year. His total wages for the year exceeds the 2023 Social Security contribution limit of $160,200. When Zachary files his tax return, his overpayment of Social Security tax is calculated automatically by his software by adding up the combined Social Security tax withheld from all his wages. He will receive a credit for any over withheld amounts. So he'll just receive it as a refund, or it'll offset his income tax on his tax return. It all comes out in the wash, is what I'm saying. But this only applies if you have two employers, because that's not considered a mistake. If you are over withheld with one employer, like you're only working for one employer during the year, the IRS expects you to go to the employer and ask them to correct the W-2 and correct their own mistake. Many times employers don't want to do that because many times the employees don't actually discover the mistake until the following year, and the employer does not want to file corrected W-2s because that costs a lot of money, or it does cost money to file a corrected W-2. The IRS states that if a single employer over withheld Social Security and refuses to refund the overcollection, like you're supposed to go to the employer first and get them to fix it. If they refuse to fix it, the employee can file a claim for refund using Form 843, claim for refund and request for abatement. Example, Donald works for a large corporation. He typically earns a $175,000 salary. In the middle of the year, he is transferred to a new location, and the Human Resources Department accidentally registers him as a new employee rather than a transferred employee. As a result, Donald gets two Form W-2s from the same employer. And this is actually what will happen. You know, if you get transferred and the company registers you as a new employee rather than a transfer, then what will happen is the employee will get two Form W-2s from the same employer, and sometimes they will be over withheld from the same employer. It doesn't happen very often, but these mistakes happen. Both of his W-2 forms show withheld Social Security taxes. He doesn't notice the issue until late April, and when he contacts his employer for a refund of the excess FICA taxes withheld, the company refuses to correct the issue, saying it is too late. Most of the time, even in the case where the company makes a mistake and they could correct it, they won't, because they don't want to file corrected W-2s. They don't want to pay for that. Since Donald's employer would not correct the error, he can file Form 843 with the IRS to claim a refund along with copies of his two Form W-2s. This doesn't happen very often, but this is the procedure. If it's an over withholding and the employee was working for more than one business, like they have multiple W-2s from multiple employers, then your software is just going to calculate it automatically. But if it's a screw up with one employer and one employer over withholds, then this is what you're supposed to do. You're supposed to request a refund by filing Form 843. That's the procedure. All right, that's the end. Next unit is Unit 14, the ACA and the Premium Tax Credit.